Peace be upon you. Welcome back to Wealth and Wisdom. Bitcoin is often described as a hedge, or more specifically, a hedge against inflation. Hedging typically refers to hedging risk. For example, an oil producer may hedge by selling an oil commodity future, locking in future revenue at a certain price to avoid the risk of interim price volatility. Inflation hedges, more broadly, are geared toward investments or derivatives that will offset the risk of general price inflation. Historically, these typically include the likes of gold, real estate, commodities, and stock indexes, anything that would be most expected to increase in value as an offset to the dollar decreasing in value. In essence, an inflation hedge is intended to counter the risk and the expectation of the dollar losing its purchasing power. Hedges protect against the potential adverse impact of different future scenarios, which may or may not occur. There is a generally understood risk that the men and women who manage U.S. fiscal and monetary policy might screw up the dollar economy, materially or completely. In this scenario, there is an argument to be made that Bitcoin has at least a chance to be an alternative financial system, which could be viewed as insurance should the political degenerates create a mess. Regardless of the cause or degree, the dollar is expected to lose purchasing power, and it presents risk worth hedging. In a worst-case scenario, the dollar could be broken beyond repair, and Bitcoin offers the promise of a currency system with a fixed supply. Realistically, it should meet the classical definition of an inflation hedge. While it may meet the classical definition of a hedge, we here at Wealth and Wisdom believe that any view of Bitcoin as a hedge or as insurance misses the most fundamental aspect of Bitcoin as a whole. Bitcoin is not a hedge against inflation. It is the permanent solution to inflation, and those are two very different things. Bitcoin might be volatile, but over a long time horizon, it is not a risk. Risk and volatility are commonly conflated but in reality, are very different. Volatility can present a risk depending on time horizon, but it is not inherently the same as risk. Risk speaks to future uncertainty, and hedges against risk intend to reduce future uncertainty. We do not see Bitcoin as a risk because the fundamental value of Bitcoin is derived from the fact that there will only ever be 21 million. It is the most fundamental basis to explain how and why Bitcoin is competing with the dollar as money. Every inflation hedge is intended to earn more dollars or appreciate in dollar terms to offset inflation, whereas Bitcoin is structurally designed as a replacement, which is a critical distinction. If Bitcoin credibly enforces its fixed supply of 21 million, then it will replace the dollar, euro, yen, pound, peso, etc., as the currency which facilitates practically all day-to-day commerce in each respective local economy. In the dollar world, inflation is a man-made phenomenon. Most simply, new money is created by the Federal Reserve and each unit purchases less in the future as a result. In mainstream economic circles, there are many prevailing theories as to what causes price inflation. We don't need to care about any of that. Just look no further than the supply of dollars. What principally confuses people is how the increase in the supply of dollars is transmitted through the economy, and specifically, to the dollar price of real goods and services. This is one place where common sense prevails. If more dollars are created, each dollar will purchase less because the creation of more dollars cannot and does not increase the supply of real goods and services available in the economy. Human time, at an individual level, is finite, but the supply of money is not. The Federal Reserve has flooded the market with trillions of dollars since the Great Financial Crisis. Dollars are becoming more and more abundant, and as the money supply increases, the purchasing power of each dollar declines. When money loses its purchasing power, it is the equivalent of an hour of work being guaranteed to purchase less than the value actually delivered in the past. All else being equal, it amounts to a barrel of oil produced today purchasing less than a barrel of oil in the future. The incentive structure breaks entirely when money is created at no cost, and the problem is not static. As more time passes and more money is created, the purchasing power of value delivered at various points in the past degrades further and further, until it eventually purchases nothing of comparable value, or time to produce. In substance, It results in people having delivered value in the past and never having the value returned. In other words, whenever the government prints money, it is stealing from you. To use an extreme for illustrative purposes, imagine you spent 40 hours in a week working for $10 per hour, $400 total. Then consider the consequence if the dollar's value were to hyperinflate, effectively trending to zero over a short period. That would translate to a week of time which you can never get back and which would purchase you nothing in the future. In the practical application of hyperinflation, it is not just a week that is lost but instead, entire life savings. It is a path to sure ruin, but really, anything on the spectrum of currency devaluation is similarly problematic. Time is required to produce work, which translates to goods and services. Any time expended in the past saved in a form of money which purchases less in the future creates a deficit. As dollars become massively more abundant and time remains finite, more dollars compete for a relatively fixed quantity of goods and services. People value each dollar less and charge more dollars for each unit of their time in an attempt to reduce the deficit created by more money having been created and to offset the expectation of future degradation. Dollars are increasing, but the amount of time is constant. Inflation is that simple, but the consequence is not. The mistake most people make, especially academics, is believing it can go on forever. Just print a little bit of money, or even a lot, and things, i.e. goods and services, will merely cost more dollars. What's the big deal? The Fed has been doing this for decades, nearly a century. If money were as simple as basic math, it might be the case. But in reality, the function of money is highly complex and consequential. Money coordinates practically all economic activity, functionally by facilitating trade between every person for all goods and services. The creation of money, especially at little to no cost, does not just cause the value of the currency to depreciate. It fundamentally impairs that currency's ability to coordinate economic activity. Hyperinflation does not occur simply because too much money was printed, in an arithmetic sense. Instead, it is the distortion of the money which actually makes trade more difficult and which causes imbalances that ultimately lead to supply chains breaking down. Yes, the currency becomes more abundant, but the basic goods necessary for survival, like the delivery of energy, become more scarce at the same time as the incentive structure of the money becomes increasingly fractured. In each instance of hyperinflation, history has shown this to be true. The currency fails completely because of the breakdown in trade, the principal function which money helps to facilitate and coordinate. Bitcoin provides a light at the end of this tunnel of debasement, a solution to the ultimate problem of money printing and greed. Thankfully, someone has already created a solution to the broken structure of the dollar. It has been functioning for the last 15+ years. Most people just don't know it yet. If the problem in the world is the printing of money, then the antidote is a form of money that cannot be printed, which is what Bitcoin represents. There will only ever be 21 million Bitcoin, and that is the fundamental value of Bitcoin. If you learned something today, please don't forget to like and subscribe. Until next time, Assalamu alaikum.